Hello, and welcome to our webinar today. I'm Larry Van Tassel, Professor and Director of the Center for Agricultural Profitability within the University of Nebraska-Lincoln's Department of Agricultural Economics. Today, as part of our Center for Agricultural Profitability's weekly seminar webinar series, which usually happens every Thursday at noon. Check out the full schedule on our website at cap.unl.edu. Economic conditions in agriculture have rebounded dramatically the past few years, alongside a sharp recovery in broader economic conditions. Agricultural commodity prices have been high, farmland prices have set new records, and farm financial conditions are considerably stronger than before the pandemic. While the factors specific to the pandemic may continue to affect economic conditions to varying degrees, the path forward for agriculture will depend significantly on the broader economic forces that are at work today. Join us again to discuss how these forces are likely to shape the outlook for agriculture in the year ahead. We are pleased to welcome Nathan Kauffman, Omaha Branch Executive, Senior Vice President, and Economist with the Federal Reserve Bank of Kansas City. In his role as the bank's lead economist and representative in the state of Nebraska, Nathan provides strategic direction and oversight for the Omaha branch, regional research, and economic outreach throughout the state. He serves as the Kansas City Fed's principal expert in agricultural economics and is a leading voice on the agricultural economy throughout the 7 states of the 10th Federal Reserve District and the broader Federal Reserve System. Nathan joined the Federal Reserve in 2012 after receiving his PhD in economics from Iowa State University. We're very appreciative of Nathan making time in his busy schedule to visit with us today. Nathan, I'll go ahead and turn the time over to you now.
Great. Well, thank you, Larry, for the introduction and the invitation to join this afternoon and share some thoughts in terms of what we're seeing with respect to agricultural conditions and the outlook. And I think you said it very well in that introduction in terms of how conditions have rebounded and have been relatively strong the last few years. The presentation that I'll share this afternoon is an attempt to recognize those conditions going back to 2020 and what we might see coming ahead as we think about 2024. So to get started here this afternoon, I'll just first begin with a little bit of context in terms of the Federal Reserve and our focus on agriculture, as many people may not be entirely familiar with the structure of the Fed and why we might be focused on agriculture. So I'll start first with this just for a minute to level set. The Federal Reserve makes a lot of effort to make sure that we're incorporating perspectives from a variety of industries and regions into broader economic and policy discussions. And agriculture always has been a prominent sector of the economy that the Kansas City Fed covers. So for people that might not be familiar with the Federal Reserve, we are the central bank for the United States, but the way that we're structured is to have 12 regional reserve banks scattered throughout the country. And that's shown by the dark bordered regions in the map on the left, in addition to the Board of Governors that sits in Washington, D.C. As you might expect, agriculture is an industry that's very concentrated in the region that we cover at the Kansas City Fed, shown in the middle of the country there in the dark shaded color. And as you can see in that map, farm income as a share of total personal income spread across geographies in our region means that we are the highest in that metric of the other reserve banks. We also have, as shown in the chart on the right, the largest concentration of agricultural banks in the United States, and then counties that would be categorized as farm-dependent counties. So this slide is really just a way of recognizing that agriculture has an outsized role in the economy and the region that we cover at the Kansas City Fed, and a part of our role is to provide those perspectives. We benefit from having connections with, the Ag Econ department at UNL and other land-grant universities in our region, as well as industries and communities across the 7 states that we cover. So this is just a little bit of context before getting started in terms of some of the things that we're watching with respect to the outlook. There's 2 main themes that I'll be addressing in today's webinar. And the first is, and has been already alluded to in the introduction, which is to say that farm income really did increase quite dramatically in the wake of the pandemic. We've seen some growth soften in recent months, and so that's something that I'll point to. It is likely, though, that profit margins will be thinner in the year ahead. But this is happening alongside the strength of recent years that we've seen that I think will continue to support farm finances. So even though we're seeing some signs of conditions softening, it's reasonable to think that the strength of the past few years will provide substantial support for agriculture in the year ahead. This won't necessarily be true for every industry within agriculture, or certainly not with respect to all regions. We know that there can be quite a bit of variation there, but as a general outlook, and my comments will be at a national level and pretty high level here, we would expect to see relatively strong conditions financially, even as we're seeing some of these tightening profit margins. Just to get started in describing some of these factors that we're watching, and starting at a relatively high level with a little bit of context also going back to before the pandemic, it's important to, I think, start with this as a high level measure of the agricultural economy and recognize that net farm income did expand quite sharply. Beginning in 2020, going through 2021, at the onset of the war in 2022 in Ukraine, and likely to still remain high in 2023, even as we're seeing some signs of softening or a bit of a reduction in terms of the forecast looking at 2023. The chart that we're looking at here shows a measure of both the United States in dark blue and Nebraska in light blue. Of course, these lines are pretty highly correlated, recognizing that agriculture in Nebraska is significantly correlated to what we would see in terms of the commodities that generally make up the largest share of agriculture nationally. It's worth, again, as a little bit of context, recognizing that incomes had been subdued for a few years prior to the pandemic before increasing sharply into 2022. And again, you'll see that forecasted decline in 2023 as the first sign, or as one sign that we're seeing some things pull back a little bit. Nebraska was down a little bit in 2022 relative to the previous year, and a lot of that was driven just by the fact that yields and drought affected conditions as it relates to corn and soybeans, and generally speaking, incomes were a bit lower than what we would have seen nationally in terms of an increase, but still well above the levels that we had been prior to the pandemic. As I mentioned earlier on, the rebound that we've seen in economic conditions in agriculture have been supported by what I would call large increases in commodity prices. This chart shows a price index for agricultural commodities for both the United States and Nebraska. And in the case of Nebraska, cattle, corn, soybeans, and wheat account for about 90% of this index. That's, of course, what the state of Nebraska is concentrated in. But as you can see, because those commodities make up such a large share of the national picture for agriculture, these lines are actually quite correlated here as well. As I mentioned earlier, those years between 2016 and 2019 were years where commodity prices had been relatively low, but then surged through the pandemic, remained high in most of 2022. And as you can see in some of the later time periods here on the chart, have started to pull back a bit. More so nationally than what you see showing up for Nebraska. And this is simply because of, actually, it has more to do with cattle prices being as high as they have been here through 2023. And I'll describe some of that in a little bit more detail. As I mentioned, economic conditions have strengthened across a number of different industries in agriculture, but especially in major row crops. I have two charts that I'll show of this format as a way to describe first what conditions have looked like as it relates to revenue or the value of agricultural production nationally. And the second one that I'll show in a few minutes will show a similar picture with respect to expenses. The way to interpret this chart is to start first by looking at the far left portion of the chart that shows the level in 2019 of the value of agricultural production. And then if you look all the way forward to the right, shows the increase and the level of the same metric here as forecasted for the year 2023. So the first thing that you'll notice is in moving from the far left of this chart in 2019 to the forecast for 2023 is an expectation of a 45% increase in the value of agricultural production this year relative to 4 years ago in 2019. And as shown in the chart, it's coming from a variety of sources, not just one particular component. Of course, we know that the crop sector has contributed a fair amount to this, and I'll have more to say on that in a few minutes. And that shows up by way of feed crops, oil crops, and other crops. But also, as you might expect, animal protein, the industry has also been seeing significant increases, and I'll describe some of that with respect to the cattle sector as well. So the slide here is simply to illustrate that it's been a pretty dramatic increase in the value of ag production. And when we think about revenue over the span of 4 years, and this being the context that I think will shape a lot of what we might expect to see in the year to come, even if we are potentially going to see some tighter profit margins. As I mentioned, commodity prices have increased over the last few years, and some of this has been supported by large increases in global demand for agricultural products. I don't have a chart to show on it, but of course we know that government payments and support from various places in 2020 and 2021 contributed a fair amount to the overall increase in farm income, but it wasn't just government payments. As I mentioned earlier, the large increases in commodity prices were supporting farm income. So as shown in the chart on the left, last year in 2022, we saw ongoing increases in exports that well exceeded the previous record of 2021, but that even higher than the record going back to 2014, and that being a year that was coming off of really 3 consecutive strong years in agriculture. As I mentioned a couple different times, the chart on the right shows that it's not just been one particular category or one commodity, it's actually been fairly broad, but specifically grains and oil seeds, and then also meat, dairy, and eggs being some of the components where we're seeing increases in exports. The chart on the right-hand side shows the average that we saw for those categories from 2015 through 2019. And just to illustrate the scale of the increase in 2022. So in the case of grains and oilseeds, for example, the increase having been from about $60 billion on average prior to the pandemic to something that was closer to about $85 billion in 2022. So substantial increases in exports coming out of the pandemic as economic growth was generally pretty strong. As we look back now at the pandemic on a more granular level to better understand where the revenue increases were most pronounced, we have a little bit better information now. As we collect data that is more specific to regions, and the map here is showing a county level basis of the increase in cash receipts relative to 2019, so the increase from 2019 to 2021, you can see that there was more than a 30% increase in cash receipts in a large swath of the Midwest, going from Western Ohio all the way to Nebraska and down into Kansas. Of course, some of the challenges associated with drought in 2021 in the West Coast, and as you move into the Southeast, looked a little bit different. But this picture is simply to illustrate that where we saw the most substantial gains in terms of revenue was centered in the Midwest. And that's going to have implications for the rest of what I describe or later on in this presentation when I get to financial implications and land values as what we might see going forward that I think will make a little bit more sense despite some of the tightening that we're seeing with respect to profits and slightly lower commodity prices. So this was one side of the equation talking about revenue, but of course it's also important to recognize the changes that we've seen with respect to production expenses. And on this slide, you're seeing also that expenses had been relatively steady between 2017 and 2019, increased sharply at the end of 2020 through 2021, continued to increase in 2022, and perhaps most important for the message that I'm trying to communicate this afternoon is that expenses are continuing to rise in 2023. We don't yet have data on a forecast for Nebraska, but I think it would be reasonable to assume that Nebraska, as it has in the past, would be likely to follow some of these national trends of seeing increases in expenses. And I'll have more to say on where some of these increases are coming from. So as I mentioned on the previous slide showing the change in the value of agricultural production relative to 2019, and we do often compare conditions to 2019, feeling as though those initial years of the pandemic were highly unusual, but generally speaking, 2019 resembled something that might have seemed a bit more normal. And as we see conditions evolve here now 4 years later, it's instructive to compare what we see those conditions look like relative to 2019. So in a similar format to the previous slide showing the value of agricultural production, expenses as forecasted in 2023 are anticipated to be about 30% higher than what they were in 2019. And these are coming from some familiar places, manufactured inputs being a big part of this, and that was fertilizer. We do know that fertilizer costs have pulled off a little bit. For livestock operations, though, that are dependent on feed costs and other things that are part of what goes into those operations, that's been a large component in terms of the increase in expenses. I will point out a couple of other places here that don't look like large increases in expenses, but they're notable because they're a bit unusual in terms of what we would have seen a few years ago. And the first is interest expenses. Interest expenses don't necessarily account for the largest share of expenses overall, and they haven't necessarily accounted for the largest in terms of increases. But we do know that for those operations that are more highly leveraged, and just recognizing the increase in interest rates over the past year and a half, this can be a significant challenge. So I'll have more to say on this one as well. The other category that I would point to is labor expenses. And even if labor is not necessarily a prominent component to the cost structure of operations in Nebraska or elsewhere in the Midwest, it is a sizable share in other parts of the country. And this has been another area where there's been some pressure in terms of costs that would have been different than 3 to 5 years ago. At this point, I'll turn my attention a little bit to talking more about where we're seeing some of the tightening profit margins, recognizing that the forecast is for commodity prices to be a bit off from where they had been last year, and at the same time seeing expenses continuing to rise. So I'll have two slides to describe what we're seeing with respect to profit margins, leveraging some data that USDA puts together on a per bushel break-even cost analysis for crops, and then I'll show something similar for the livestock sector on the next slide. So the way to interpret these two slides is that the bars that you're looking at on the charts represent average break-even costs at a national level, or production costs, and the blue boxes that you see generally above the bars would represent the selling prices for the respective commodities that are being shown throughout a calendar year. So whenever you see this blue box above the bars, it would suggest that there have been opportunities for producers to sell at a profit, particularly if they're considering marketing, in this case, grain, in advance of harvest. So as you can see in this chart, focusing first on corn, and it's a similar story for soybeans. In 2021 and 22, you saw ample opportunities for producers to sell at a profit. In fact, if producers happened to sell and hit the high of the market in 2022 and sold around $8 a bushel, while break-even costs, of course, had increased from previous years, they were still at around $4.50. And so you were looking at the potential for $3 or $3.50 or so per bushel profit margin, again, as an average spread across many different types of operations. What I would point to next, though, is in 2023, the orange dot on this chart, and that simply represents the December futures price for corn, which is often taken as the harvest price. And here, the message is just simply to say that harvest price is actually not all that far above what we would consider as break-even costs on a national average level. So coming off of some levels that profit margins would have been considerably higher the past 2 years, we are seeing those signs of tightening profits. It's a similar story for soybeans, of course, and this isn't surprising just given the rotations that most producers apply for both of these two crops. And you can see that for the most part, there have been opportunities to sell at a profit for soybeans throughout 2023, and generally profit margins a bit higher with that orange dot, in this case representing the November futures price for soybeans. Still a little bit higher than production costs on average, but coming down from levels we've been the last 2 years. Shifting next to the livestock sector, this is actually a considerably different picture, not just from the crop sector on the previous slide, but also as we look at profit margins for both cattle and hogs. The chart on the left, again, similar format, would show that in this case, profit margins in the cattle industry have been exceptionally strong, especially for those operations that have not been particularly affected by drought. There may be some parts of the country that this would not be a relevant picture, just given the severity of drought in some of those locations. And in those places, producers may not actually have cattle to sell to the extent that would be in other places and be able to take advantage of some of these profits. But cattle prices have been increasing quite rapidly over the past year or two and have supported some of these increases in profit margins, despite what you see as the picture for sharp increases in production costs over the past 3 years. It's been a very different story in the hog industry, as you see in the chart on the right-hand side, where there have been severe challenges throughout 2023, and in many cases, profit margins being sharply negative for most of this year, and that being a bit of an anomaly in terms of what we're seeing with respect to strong conditions in agriculture and other markets. One of the other risks that I mentioned, in addition to declining profit margins, or I should say tightening profit margins, is that we're seeing interest rates rise rapidly over the past year and a half. And I'll have, again, a little bit more to say on this one, but recognize first that it's a risk that presents itself as obviously an additional cost for producers that are looking to expand or finance things, but also a cost that is different than most producers have experienced in recent years. So the increase that we're seeing in interest rates, as shown in this chart, has been for all types of loans, not just operating loans, but also real estate loans, and has been somewhere on the order of about 5 percentage points. So going back to the lows that we would have seen in 2021 and 2022 with respect to interest rates at anywhere between 3 and 4%, we're now seeing those interest rates above 8%. And that would be consistent with what we see in other markets, as many people would be familiar with mortgage rates having also increased now above 8%. I would note, though, that interest rates, even at this level, are still comparable to 2007. And many people will remember that as a time when profits actually were quite strong in agriculture. So even though the increases in interest rates are a challenge for producers and it adds to the cost pressures that are being seen in other places, it's not to suggest that there aren't still opportunities for profits, but it's simply to describe this as an additional risk. One of the other risks that we're paying a lot of attention to here in 2023, and it's something to watch as we enter now the fourth quarter of this year, is that we are also seeing softening in export activity. I mentioned earlier that 2022 set a new record for agricultural exports, and that was on top of a previous record in 2021. But now we're starting to see a bit of a pullback. Some of this has to do with what may be softening economic conditions globally. Some of this may have to do with exchange rates and recognizing that the dollar has strengthened considerably against a broad basket of currencies. But these two charts are to demonstrate the weakness that we've seen thus far in 2023 as also being a bit broad. It's not one particular country and it's not one particular product, but we're seeing a pullback in a number of different locations and across a number of different products. We, of course, know that there are challenges and concerns about the economic outlook in China, and China having become a much more substantial buyer of U.S. agricultural products. This represents a concern, as shown in the chart on the left. But it's also been other countries and destinations as well where we're seeing this pullback relative to last year, after having seen, as I mentioned earlier, a sharp increase in exports to a variety of locations. The chart on the right shows that we're seeing the most significant pullback in export activity for both corn and cotton on a percentage basis. But as mentioned earlier, the decline that we're seeing really is across a broad set of commodities and products for the reasons that I mentioned earlier in terms of just generally slower economic activity and also the value of the dollar that's changed over the past couple of years. So despite all of these risks, as we're seeing tighter profit margins, as we're seeing expenses that are generally expected to increase at a time when commodity prices are declining and interest rates are increasing, which is an additional risk, we're seeing headwinds with respect to export activity and what I would describe as a generally more subdued economic environment in terms of growth. Despite all of those risks and all of those developments, we still see financial conditions in agriculture extremely strong. And this is coming primarily because of the strength of the past 3 years in agriculture and what many producers have done in terms of making sure that their financial position is strong and paying down debt where they're able to take advantage of the past few years and be protected against any potential risks going forward. So there's a few data points that I would point to here as support for why I think we would expect to see strong financial conditions in agriculture persist despite the possibility of some of these tighter profit margins and ongoing risks. The chart on the left shows two financial measures that we look at a high level to illustrate this point. One is a measure of working capital. And for producers that are facing maybe heightened risks that could be associated with a variety of factors, the first thing that a lender will look at is the working capital position of an operation. And the picture that you see here with respect to working capital would show that nationally, working capital is substantially higher than what it was during those years from 2016 through 2019. It's pulled back a little bit in 2023, but still at considerably higher levels. Not quite to the point that we had been during those years from 2010 to 2013, but notable nonetheless. The other measure that we look at as a debt to income ratio is representative of leverage. So the extent to which producers are taking on debt based on the income that they would have to then repay that debt. From 2015 through 2019, this measure was actually quite high. And there was some concern that the leverage that producers were taking on might lead to maybe some increasing financial pressure, especially as we entered 2020. But as other data that I've shown here, we've seen some of those measures of leverage decline. There's a small uptick in 2023, and that's coming about because of two things. One is that producers are continuing to take on debt, and that's generally been a trend over a long time horizon. But it's also recognizing the anticipation of income being a bit lower in 2023 than it had been last year. So again, something to watch, but leverage not to the extent that it had been during those years prior to the pandemic. The chart on the right then is a good financial measure for understanding how we see overall pressure in agriculture that might come about because of lending. The chart shows delinquency rates on farm loans for both commercial banks and the farm credit system. Those two entities combined are about 80% of overall ag lending in the United States. So to the extent that we would see delinquency rates on farm loans being very low, that would be again indicative of seeing overall financial strength. I would point out that this chart on the right-hand side is probably not the best forward-looking measure of when we might see financial stress, but it's simply to illustrate that stress in agriculture, financial stress in agriculture has been extremely low. In fact, the lowest, that we have going back at least 20 years, but potentially even beyond that, both for the farm credit system and commercial banks. So continuing to see that borrowers are in a strong position despite some of these challenges that I've been describing here in the presentation. In addition to the strength of the financial strength of agriculture and producers, we're continuing to also see increases in land values. I think this is worth emphasizing and underscoring a bit more because normally we might expect to see some declines in land values given the scale of increase that we've had in interest rates. This is true in most asset markets that we would generally expect an increase in interest rates to weigh on markets such as land values or housing prices. But in fact, we've seen those hold up better than what might be expected. The data that we would have for both the US and Nebraska for 2023, and in the case of Nebraska, this would be through the second quarter of 2023, would show an increase of anywhere between 5 and 7% in land values. So again, despite the increases that we've had in interest rates, we're not yet seeing a meaningful pullback in land values. Cash rents have also been increasing over the past couple of years and have generally remained pretty steady. I think that's likely to be the case through the rest of 2023, just given, again, the financial strength of most producers over the past couple of years. It might be reasonable to think that if profit margins continue to tighten, that both land values and cash rents could decline a bit, or at least the growth soften somewhat. And we did see that play out during those 5 years prior to the pandemic from 2015 through 2019 and even into 2020. So I'm going to end my presentation here just by recapping the major themes that I wanted to highlight, and then I'll be glad to take questions. Despite what we would see as heightened uncertainty, and this could be because of a variety of factors in the broader economy, it might be interest rates, it might be softening global economic conditions, it might be tightening credit availability that we see alongside some of the challenges that lenders are facing with maintaining their own liquidity, costs remaining elevated. It still seems as though financial stress in agriculture is likely to be pretty limited going into 2024. And again, most of this is because producers have done rather well the last few years and have taken a fairly conservative approach with respect to debt to be in a strong position. I would again emphasize that this won't be true for every industry. I alluded to the hog industry as one example where there's some pressure. Conditions in the dairy industry were pretty good last year, but seeing those conditions change now here through 2023 and expected in 2024. So there may be some industries and some geographies where this isn't true, but in aggregate, and especially in the crop industry, conditions are likely to be supporting overall financial measures in 2024. There are some things to pay attention to, though, and I would put at the top of this list in terms of risks the general strength of the global economy. There's been lots of talk about potential recession, and again, some of this coming about because of concerns with respect to increases in interest rates. There are things to pay attention to with respect to agricultural exports, especially in the fourth quarter when we tend to send most of our ag products to China and into the first quarter of 2024. So those will be some key risks to monitor just in terms of the effect that they may have on supporting commodity prices at a time when I think that most producers would sympathize with expenses still being relatively high and not seeing a lot of relief on that front in some places like fertilizer, but in other places not so much. And energy costs continuing to rise now after pulling back a bit. So these are some of the risks that we're paying attention to. But again, given the scale of increase in incomes and profits over the last few years, we wouldn't see substantial financial stress in the year ahead, despite some of the concerns about tighter profit margins. So Larry, I'll stop my presentation there, but I'm glad to take questions if there are some in the chat and see what might be on people's minds.
All right, thank you, Nate. Those of you that are listening today, if you have any questions, please feel free to put them in the chat or the Q&A, and we'll address those. Maybe starting off with Nate here, you just mentioned some of the chatter that's been going on with the potential recession, some of the fears around that, and talked about exports being a key risk there. Are there any leading indicators that you watch or that we should be keeping an eye on with respect to a potential recession?
Yeah, there's a number of indicators that we're paying a lot of attention to. I think that what I would point to first is what we might see with respect to any changing trends in how consumers and households are behaving in terms of their spending patterns. The US economy is pretty significantly dependent on consumers to drive economic growth. And throughout the pandemic, that spending was at a very high level, in part supported by government payments and programs of various sorts. But we're starting to see some initial signs of some weakening there. And I'll point to a couple things that are maybe worth paying attention to. The first is credit card debt. We've been seeing credit card debt rising, and it's starting to put more stress on households to be able to maintain their level of spending. I think there are some questions about how student loan repayments will also affect ongoing spending. The savings rate, as we would look at households to ultimately drive the potential for future spending, is also down quite a bit from where it had been just a couple of years ago, but even less than it had been in 2019. So we're seeing some signs in the U.S. that consumer spending is maybe showing some signs of weakness there. It's playing out in terms of business optimism, especially in the manufacturing sector. As it relates to the services sector, we continue to see households and consumers spending there, sort of pushing through on some of the inflationary pressure. So there's a number of measures that we're watching. We're watching, of course, to see signs that inflation is pulling back a bit, because that would be directly linked to what the Federal Reserve may be considering with respect to interest rates. So those would be a couple of things that I would point to, but any measure that sort of gets at how the momentum in consumer spending is playing out would I think be important in terms of trying to recognize turning points.
All right, thank you. Appreciate that. Again, if anybody has any questions they'd like to put out there for Nate to discuss, please feel free to do so in the chat and Q&A. We'll give people a couple of minutes to see if they want to put anything out there, Nathan, and then we'll let you get back to your busy schedule there.
as people are thinking about questions there, Larry, the other thing that I would describe here, because it's most connected to interest rates, is what we might see with respect to credit availability. In the past, recessions tended to come about because you would see a combination of forces. You would see a pullback in consumer spending. You might see credit conditions tightening as lenders were being more cautious about how they were extending loans, given the environment. And so that's something else that we're paying a lot of attention to, is the extent to which we're seeing credit conditions being tighter than what they've been in the past. In the case of agriculture, we haven't necessarily seen any signs that would suggest that there have been substantial declines in credit availability, but there are some signs that, more broadly speaking, there are some concerns there. Commercial real estate is an area that we're following pretty closely because we think there are some risks there. So credit availability, again, is something that we're watching pretty closely, just to see if, again, the change in interest rates and cost pressures, tighter profit margins would eventually translate into more difficulty with respect to financing and put producers in a more difficult position.
Do you feel, Nathan, that the war in Ukraine right now, that we pretty well kind of adjusted or come to a new equilibrium given that?
I think it's still a risk that's there, especially as it relates to global markets, and especially as it relates to the sourcing of certain types of commodities, in particular wheat and corn. But I do think that there's been some amount of adjustment that's come about over the past couple of years. Initially, some of the shock and the estimates of production coming out of Ukraine, I think, really left a lot of concern about how global markets might evolve. But I do think that those markets have adjusted to some extent. I would still characterize it as a risk, though, where it has the potential to factor into, again, commodity prices and volatility, specifically for wheat and corn, and maybe an outsized impact for food prices in other countries that would be highly dependent on grain coming from those areas.
Okay. Well, Nathan, you did a great job today. It looks like that we're don't really have any questions that have come forward here. So we'd like to thank everyone for joining us today, and remind everybody that a recording of the webinar will be posted at cap.unl.edu, where you can also register for other upcoming webinars. Our series continues next Thursday with a look at sustainable groundwater management in California and potential implications for Nebraska. Please click the link in the chat box here to take a brief survey and provide feedback regarding this webinar, and to inform us of any upcoming sessions that you may be interested in hearing. Again, thanks for joining us, and hope everybody has a great day. And thanks again, Nathan. Appreciate your time and efforts.
Yep, thank you.